Okay, let's just jump right into it. In this explainer, we're going to completely reframe how we look at the Indian recycling sector. For decades, you probably saw it as just a basic civic utility, right? Unorganized, messy, and frankly, completely ignored by serious capital. But today, we need to view it through an entirely different lens, as a high-margin, core resource extraction theme. Welcome to the era of Indian urban mining. We are literally leaving behind the unorganized waste collection of the past, that whole era of informal ragpicker networks. What's replacing it? A space defined by high-margin, institutionalized, and tech-driven urban mining. With strict pollution control laws, GST tracking, and digital tracing systems rolling out, it's becoming financially impossible for the informal guys to compete. But the absolute game changer here, the regulatory engine driving all this formalization. Which brings us to our first core driver, the catalyst, extended producer responsibility. Let's look at the exact regulatory mandate that's forcing corporate India to clean up and formalize this entire sector. Now, extended producer responsibility, or EPR, is definitely not just another environmental law. Think of it as a pure financial catalyst. The government is basically telling producers and major brands, you must offset your waste by buying EPR certificates from certified formal recyclers. So what does this actually mean? It means recyclers are essentially generating a pure software-like revenue stream just for processing waste. It creates this massive margin buffer right on top of their physical commodity sales. It's brilliant. Moving on to Section 2, the 3 resource arbitrage plays. Let's look at the market itself and see how this thesis plays out across 3 distinct verticals. And as you can see, all 3 segments are forecasting some seriously robust structural growth. We're talking an estimated 8.74% compound annual growth rate for e-waste, mostly driven by how fast we all replace our electronics these days. Then you've got plastics and PET pushing in 9.45% CAGR because FMCG giants are just scrambling to secure food-grade recycled polymers. And industrial metals and batteries, heavily spurred by the EV revolution, looking at nearly 9% growth. Severe domestic supply-demand gaps and rapid corporate refresh cycles are just pouring fuel on this fire across the board. But here is the crucial point for investors. The massive margin cushion. Smelting recycled metal scrap uses up to 90% less energy than processing primary mined ore. Just think about that for a second. Traditional mining means moving literal tons of earth just to get a few grams of precious metal. Urban mining completely bypasses that massive energy and capex burn. It gives these companies an immense financial buffer, even when broader commodity cycles take a hit. All right, Section 3, Key Players and Business Economics. Let's look at how specific listed companies are actually capturing this arbitrage. And just to be clear, we're strictly analyzing their business economics and strategic moats as case studies, no buy or sell recommendations here. When you look at the competitive landscape, what's really fascinating is that no 2 players are doing the exact same thing. Every company leverages a completely different strategic moat, capital intensity, and EPR strategy to drive returns. Let's break a few of these down to see how they actually operate in the trenches. Take Gravitata India, for example. They operate as a multi-commodity recycler. What really sets them apart is their premium return on invested capital, which hovers right around 24%. How do they do it? By diversifying their raw material sourcing globally, pulling from Africa, Central America, and Asia. That geographic spread acts like a shield. It insulates them from domestic scrap shortages and lets them scale aggressively toward a target capacity of over 8 lakh tons per annum by FY29. Meanwhile, Ganesha Ecosphere takes a totally different approach. They've built an unmatched collection network of over 300 suppliers nationwide, but their real margin expansion comes from a strategic pivot away from basic commodity plastics into high-value products. They're turning out food-grade recycled PET, rPET, chips, and specialized yarns that global FMCG and fashion brands are heavily mandated to use. They're essentially cornering a high-barrier premium market. And then there's eco-recycling, utilizing a highly capital-efficient, asset-light approach to e-waste. By securing top-tier data destruction certifications, they've built an immediate barrier to entry against the unorganized scrap guys. This allows them to lock in these sticky, high-margin B2B corporate contracts, which drives an impressive return on capital employed of approximately 30%. Pretty incredible efficiency there. Now, for Section 4, the reality check, core sector risks. Because to maintain our analytical rigor in this explainer, we absolutely have to challenge the bullish thesis. What are the real-world commodities cycle risks? Well, the biggest threats to capital efficiency fall into 3 buckets. First, sourcing friction. You can have a state-of-the-art plant, but if it's sitting idle because of bottlenecks in local scrap collection, that destroys capital fast. Second, LME volatility. Base metals are priced against the London Metal Exchange, so a global price crash can compress revenues no matter how strong domestic demand is. And finally, compliance arbitrage. If state boards get lazy and fail to enforce those EPR penalties we talked about, corporate clients might just stop buying certificates, instantly drying up that high-margin revenue stream. Bringing us to Section 5, Conclusion and Evaluation Framework. Let's synthesize everything into a concrete framework you can actually use. Over the coming quarters, to separate the structural winners from the cyclical losers, here is what you must track. 1. Watch their CapEx commercialization timelines closely. Execution is everything. 2. Monitor their margin resilience by charting the spread between raw scrap costs and finished metal prices. And 3. Do a strict audit on the market pricing stability of those vital EPR credits. Ultimately, when you're evaluating this rapidly maturing sector, you're looking for sustainable moats. The biggest question to ask yourself is this: can the company's value-added products outpace commodity down cycles? If they're successfully moving up the value chain, say producing food-grade chips or high-purity metals instead of just basic ingots, they are building a shield. That shield is what protects them from the inevitable commodity price drops. Thank you so much for joining this deep dive explainer into the Indian urban mining transition. Brought to you by PhanKK, Wings of Wealth. Clarity, consistency, compounding. Just a quick reminder before we wrap up, all information presented in this analysis is strictly for educational and informational purposes only. It doesn't serve as financial or investment advice, and it's definitely not a recommendation to buy, sell, or hold any security. But I want to leave you with this final provocative thought. As global supply chains tighten, are you still solely looking for resources buried deep in the ground, or is it finally time to start mining our cities? Keep researching, keep compounding, and we'll catch you in the next explainer.